Before we get started with today's show, I just want to take a couple minutes to talk about permissionless for the next conference presented by Blockworks. It's happening in June 24th to 26th in Brooklyn, New York, and it's all for the developers and builders in crypto. So if you're interested in really understanding how the nuts and bolts of the crypto industry are being built and you want to learn more, go ahead and get your ticket. I'm going to be there as well as with Quinn and the rest of the Forward Guidance gang. It's going to be a ton of fun. So use the code FG10 at checkout and you'll get 10% off your ticket. So really looking forward to seeing you there. Prices are going to be going up pretty quickly into the lead up of the event. It's only a couple months away. So be sure to act real quick there to get the best deal. All right, back to the show. All right, what's going on, everybody? Welcome back to another Roundup edition of Forward Guidance. We are recording a couple days early because of the long weekend coming up, but wanted to get this out there. No shortage of things to talk about, that's for sure. We've pulled back in our Pepe Frog buddy, Capital Flows. Been on here a couple times. It's always a ton of fun. What's going on, man? Good to have you back.
Yeah, happy to be here. Thanks. It's actually good we're recording earlier, so tomorrow's last trading day before Good Friday. And, I think today there's some data tomorrow, but the bulk is with Powell's speech and retail sales probably through. So it's a good time.
Yeah. Can arm some people some knowledge. Okay. Let's get into it. Markets fell apart again. They started to fall apart yesterday in after hours when we got the headline drop of the US basically banning NVIDIA GPUs from going to China. And that got the momentum reversing pretty substantially. And then it just kept on going throughout the whole day. And we got the Powell presser. He came out and had some remarks. I unfortunately missed it. I was busy recording a podcast. But Quinn, would love to hear, it sounds like you were on top of it. Would love to hear what were your high-level takes on that?
Yeah, so we've obviously had quite a slate of Fed speak over the last, say, 4 to 5 trading days. A lot of them have been non-voting members, but still useful data points nonetheless. And I'd say the recurring theme has been a really large cautiousness and hesitation around any cuts, and pretty pessimistic about the impacts of tariffs and how that affects their job in setting policy and supporting the economy if the two goals of stable employment and low inflation go against each other. So earlier this week, we had Waller speak, who obviously is people listen to what he has to say. And I found it weird that everyone took from that super dovish, saying, he mentioned, they would step in if something went awry, which is nothing new. But I actually, so maybe that was dovish if things really got nasty. But I actually took his base case, which was the sort of status quo tariffs, like 10, 15%, not something crazy draconian, but something more run rate after some trade deals were struck, to be more hawkish. Because in that case, he said, I assume tariffs might land at around 10%. And, in that good case where inflation is less persistent, we might be able to cut rates later in the year for good reasons. I took that to be pretty hawkish relative to where the market is expecting the first cut in June, because he said latter half of the year. And then, so I think people skated by that, and a lot of people were saying, "Oh, Waller is interviewing for the next FOMC chair," which also doesn't add up because he's the only one on the committee that voted against ending QT, which, in my opinion, was a very clear directive from Bessent to Powell, probably to effectuate earlier than anyone expected. So that doesn't jive. And then I was reviewing Powell's latest speech, which came after Liberation Day, before today. He was very hawkish. He was reasonably hawkish then, trying to decipher what went down. And today he brought out the gun. So he characterized the economy as still solid. He said employment's at or near full employment, maximum employment. He said he really focused on inflation, tariffs, as you can imagine, but stressed the need for them to balance and wait and not let, even to the point of saying, if inflation expectations become unanchored and they don't achieve their goal on inflation, that jeopardizes their other mandate of full employment. I mean, he went into talking about the United States as potentially threatening to lose its place as an attractive investment jurisdiction. He noted that last week's market functioning was orderly and as expected multiple times. I mean, VIX at 60 and treasury market seizing up. I think, the dollar and yield correlation reversing, like these are things that were not orderly at all in most market participants' opinions. And he just, continued the very, very patient. We have time. We have to see. And yeah, I think the market is basically saying, okay, well, I guess we have to test that because, I think financial conditions have tightened quite dramatically. It's not that I don't think inflation could be a problem, but if markets kind of go kaput, then you probably really don't get inflation because you have a bigger kind of recession on your hands. So to me, he was very, very hawkish. It stood out to me as the most hawkish he's been in a very long time. And yeah, capital flows, I'd be interested.
Yeah, I want to, Capital, especially want to hear how you take that with, you're always so good at seeing how the tension of that is reflected in market pricing. So yeah, like how are you taking this dynamic of where monetary policy is at, and especially as reflected in the market as you see it right now?
I would say a lot of my macro view over the last week has pretty dramatically changed in terms of how I'm thinking about running trades, and then also thinking about these tariff things, and then also the tariff news, and then also from the releases from Powell. I think, coming in maybe I guess it's about a month ago now, I thought the forward curve was probably pretty cheap. I think especially the 2026 SOFR contracts, all of those just had a ton of upside in my view. And then we basically had that, blew out to the upside, priced almost emergency cuts. And then, we've come back down from those levels. And all of that, that on the short end, that took place as sure the long end rallied, but we began to see a steepener twist, which basically means that the longer bond, let's say TLT, and the longer duration stuff, it's not rallying at a commensurate rate as the short end, right? So it just means short-term stress, not systemic unwind. And I think it was kind of there where I believe you have both Powell. I actually think Powell and Besson are probably working together pretty closely. And I think the narratives around Powell becoming being the next Fed chair, whatever that might be, I think that's a little bit of a misdirection by the market or by the media. I think what we're seeing is all the tariff risk is basically, you have all of these countries that are, coming online with the US, and they're saying, okay, I'm going to do these tariffs and we'll work out some type of deal, right? But then China is the largest trade partner, right? And so I think I've shifted my view where I don't think about tariffs now in the current situation, and this could change, but I don't think about them as explicitly inflationary or disinflationary or bullish or bearish for growth, because I think it's independent of that right now. Because right now, if what I've basically been doing is breaking down, okay, what are all the main impacts of tariffs in the US? Where is it at in the supply chain, and where is it at for durable goods and these base materials that we have? And then saying, okay, what are just good ways to express trades in there? Because if you have a tariff that's slapped on and a company says, well, we don't know what's going to happen, maybe we need to onshore, and then that gets flipped, right? Then a company just invested a bunch of money that it's going to get rugged on. And so their stock price is just going to go up, and then maybe it's going to go down, or maybe it just gets smashed again, right? So you have this kind of time frame thing that's interesting there. So I think because of that, in the underlying economy, what we are going to have is underlying rotations that are not the same, but similar to what we saw during COVID and 2021, where you had, if you remember, you had this massive rotation from goods and services back and forth as we had the reopening. and you had the entire labor market and consumption market move in lockstep with that. I think we are going to see the opposite or a similar rotation where you have these supply chain shifts, and you want to be able to find some type of expression that has positive optionality in multiple scenarios. So like very simple example is I sent you a chart of MP, the just material stock, and that's been doing really well. I just think you have these really interesting plays where you have US puts up some tariffs, and then China says, oh, we're going to do this, and now you have China saying we're not going to export any earth metals, and then now you have MP outperforming Mag 7, which is MP is just the main US domestic company producing rare earth metals, right? And you have that outperforming Mag 7 on top of this entire shift toward AI. I mean, the more I think about AI, I just think about Mag 7 as moving into like utility type companies where their margins are directly leveraged to, just rare earth metals, semiconductors, like commodity type stuff. I just think all of the skilled labor that they have, which is obviously amazing, all that stuff, it's getting more and more commoditized, even though they have an edge and a moat in it. And so I think you have this shift where I want to take more bets on where are the companies that are going to benefit from this shift in both the tariff side and things like that. So with that, connecting back to Powell's statements, I think Powell and then also the market is looking for some type of inflationary or recessionary risk when I think it's going to get, I think we can move higher in bonds just because I think growth is going to suffer a little bit because corporate earnings are going to fall off a bit. But I don't think we're going to have some massive unwind because the corporate earnings coming off are primarily going to push capital back to the compensation of employees, right? So it's not going to be, some massive deleveraging, right? These tariffs are pulling, you pull companies back, they, are investing in the United States. Sure, prices are higher, but that also means wages are higher as well in a commensurate way, right? So prices might go up, but real wages might keep up. And you actually have more money that the consumer has a larger portion of GDP that they're actually able to spend. So I think about it in those terms where I think Powell and I think the market are going to keep misinterpreting these changes, and it's going to keep getting whipped on either side. I think we'll probably over the next year or two move up in bonds, maybe a reasonable rally. I don't think it's going to absolutely blow out. I think we'll move up in bonds. Maybe we'll chop in stocks, but I think the stock side will be more underlying rotation where Mag 7 is going to have headwinds, but it's not going to. I don't think Mag 7 is going to have this nifty 50 deleveraging where they're never going up again.
Yeah, there's some interesting points in there. It sounds mostly as if, you believe there's better value in some of the more microstructures of the rotations of the impact of these changing tariff flows and like capital flows, as opposed to trying to take a directional punt on equity indices based off like the most recent tariff headline. Is that correct?
Well, yeah, because I think the difficulty is that all of these headlines that are coming out, and I've just been digging into all of them, the difficulty is that they have such massive structural implications. So like if you have an actual like tariff the size we have on China right now, I guess we actually have it on them, right? If that actually pulls through, like the entire trade relationship with China is kind of screwed, right? It's like you have China being the largest surplus nation and the US being, largest current account deficit nation in the world, right? You have one of two options, right? You have China basically restructuring and rerouting all of their trade through other countries, and so they export by proxy like they've been doing with a lot of different things. Or you actually have China move their current account deficit up, but that means their entire economy needs to shift more to consumption, which based on what China and their stance is right now, it doesn't seem like they want to. Well, it'd be very difficult for them to do that because they still need dollars to manage their currency, right? Like if they want to maintain the type of regime that they have, they need to maintain the capital controls that are in place. So I think on all of that stuff where it's like we're trying to make sure China doesn't get NVIDIA chips or anything like that, all of that, like they have been sidestepping around all of that for basically years now, right? Like we've told them that we don't want them. We've had tariffs and whatever else the regulation might be for them not be able to get NVIDIA chips, and they still get them. And same thing with them exporting to us, right? They've exported through Mexico to the United States. So I just think the game that China has been playing has been on their terms for years now. And now Trump and Besant are basically coming back and giving them a little taste of their own medicine. And they're using they're weaponizing their current account in the same way that China has been doing it for years. And the interesting thing is, like, I just think all of these headlines have structural implications, right? Because if you actually go with the headline, then it means complete restructuring of the entire global economy.
What stablecoins did for the US dollar, Ondo is doing for stocks, bonds, and more. They're making real-world assets accessible on-chain, laying the foundation for the next wave of financial innovation. With tokenization, Ondo Finance is transforming how financial assets are owned and traded. Discover how Ondo is revolutionizing capital markets at ondo.finance. That's ondo.finance. Restrictions apply. Yeah, I mean, on that point, like something I've been thinking a lot about in terms of just US denominated assets. And I've been really focused on just seeing like cross correlations between different asset classes for trying to gauge, is this rotations or is it just margin calls and degrossing? So like today, for example, we have the Q's down almost 4%. We have gold up over 3%. We have bonds rally. We had Dixie down, and trying to think through how are those interplays coming together in this realm where, okay, if we're weaponizing the current account, if we're trying to lower the trade deficit, that leads to less US dollars going to the rest of the world because less goods are coming to the US, therefore less reinvestment into US denominated assets because there's less dollars going to the foreigners. So I try to think through, like, how are these cross correlations trying to price in that potentiality? And Quinn, I'm curious, like, what are you thinking about all of that?
So I think that the dollar re-rating lower was going to happen regardless of tariffs. Tariffs likely sped run it. But what, in my view, was attributing to the dollar strength was something I wrote about middle of last year, and I called it the AI safety trade, which was everything across the globe from a risk asset perspective was faltering. Germany, Europe was effectively in a recession. China was in a recession. Emerging markets not doing well. And the only thing to rely on was the AI related hyperscaler CapEx boom. And those were largely US assets. And as a result, everybody across the globe piled in, so much so that Mag 7, these hyperscaler trades, became 40% of the S&P 500 stock market composition. 40% across 7 to 10 companies in one new sector, effectively. That's unheard of. And it fed on itself, which then reflexively made people want dollars to buy dollar assets. And what made it all possible, in my opinion, was the fiscal excess, which was made possible by the liquidity provisioning from the Treasury and Fed via RRP and other things to support that rampant fiscal spending without crashing the bond market. So all of those problems were then handed over to the new administration. And these are the reasons I was bearish Mag 7, bearish US stocks going into the year. And again, the tariff situation sped run it. And we were calling out in January and Feb the notable divergence in economic strength. And under normal course in Europe and Japan and China and maybe EM, that economic strength may have continued and powered those equities. But as everyone knows, when the US catches a cold or sneezes, the rest of the world catches a cold. So we are now moving to a regime, I believe, which is much more recessionary than I would have expected this soon earlier in the year. I think the Fed is extremely behind the ball. I believe capital flows. Earlier in the year, I was with you, and I think is in February where I said that very much opposed to what the common narrative of, oh, Trump and Powell are going to be going at it again in this term. I thought that would come later after they do these things and affect these policy changes. But when the market was starting to roll over, I mentioned how Bessent and Powell are on the same team because Bessent wants to get growth down. I mean, he wants to get the 10-year down, and to do that, he wants to cut deficits, and the byproduct of that is slower growth, and that brings yields down. And Powell wants all of those things to bring inflation down. So they were hand in hand, the same team. The way things have progressed, however, and the how the bond market and yields have transpired tells me that financial conditions have tightened much more than I expected and are much tighter than you would normally see in a big risk asset sell-off. And I think the Fed is becoming increasingly behind the ball. And today's hawkish press conference solidifies that even more. And I think if May does not happen from like a liquidity support perspective, I think the market rolls back over basically. So I'm sort of the view that Powell's hand is either forced ahead of May via pukage between now and then, or maybe Trump and Bessent get some trade deals, the market kind of stays afloat, and we float into May FOMC, which I would not, if that happens, I would not expect to cut. And then I would imagine it to play out sort of like July of 24, in the sense that a month later, Powell basically admitted they should have cut. And they did 50 in September as a result. But I think that's how dire the growth situation is becoming. And obviously all the data we're getting is very lagged. Retail sales today was fine. Showed some front running on autos.
Nobody cares about though.
I think it's a very big mistake and inconsistency in my view to extrapolate the definitive, quote unquote, they're identifying as definitive inflationary impacts without, extrapolating. They're using the economic health look back, which is okay, but they're using the tariff forward inflation impact. They're speaking out of both sides, because if they just reacted, they would say labor market is okay, it's weakening, but inflation's looking a lot better. We just got some really good prints multiple months in a row. Or if they said, we're going to look forward, inflation could come up, but growth is seriously declining by almost every forward indicating measure in soft data. But what they're doing is they're saying we won't look at the soft data as gospel for forward, but we will look at soft data as gospel for forward inflation. And it's hard to explain from my perspective.
Yeah, it's really interesting. I'd be curious because I have a little bit of a different take. I think in terms of actually, if you pull up the chart, there's two charts I brought for positioning and then also for what was the equity risk premium. Yeah, so this is just a positioning premium driver that we have in the S&P 500. basically we go through all the major positioning metrics for how you pay a premium or discount to be able to be long or short. And then when it's blue, it's putting upward pressure and predicting a higher S&P price. When it's white, it's predicting a lower pressure, right? And what we saw moving into, we were basically coming into the lows of, I guess 2 weeks ago now or last week. You had positioning getting so compressed that it was going to get blown out to the upside, which is why we had the 10% day. Like that's why the driver moved to the upside. That's why, the model basically caught that. Now we've basically flat, which is, this chart is from yesterday. So I'm not really surprised that we're down on the day today because basically positioning is really complacent. And then if you go to the other chart for the risk premium driver, this I think, connects to your point where I think, equities are still a little bit rich. Basically, the chart is just showing, given where the return of equities are relative to every other asset, should it be higher or lower? And right now, it, in my view, probably a little lower. That's just what the chart's saying. So what I view is, okay, yeah, equities are a little bit rich right now. I think they can move a little bit lower. I don't, think that's, totally insane. But I think in terms of I think that can reprice in terms of just the premium, but in terms of an actual recession or anything like that, I don't know if the data is really lagging in terms of like all the alt data or real-time data or anything like that. We still see that's pretty positive. I think the economic data for last month is sure, it's kind of like in the past, but I think in terms of actions by consumers, in terms of like restaurant data, people going different places, like people spending, all of those kind of different major things, I think those are all still positive on like a real-time basis, like week over week. So I don't really see this kind of like in terms of that kind of dynamic you're talking about where you're like, okay, you have this backward looking data and the tariff is presenting risks. I think the tariffs, they can put some downward pressure maybe on corporate profits, but we're still seeing the labor market expand like month over month, week over week, stuff like that. So
Yeah,
I guess I'm not really, where would you kind of fit in with that kind of idea? Like maybe we reprice, but maybe like I don't see this imminent recession or the driver of that.
Yeah, I'll add a little bit here, which is that I don't see a outright recession, but I think the way Quinn is characterizing is that, okay, let's take the broad economic traditional view of tariffs is that based on, say the 26% effective tariff rate we have, if we get that on a 12-month basis, some economic forecasts are for about a 1.5% to 2% increase in CPI. And so it sounds like what they're doing is adding in the CPI component, but they're not adding in the forward-looking growth component, which is that growth will be lower. So say we're coming in at just under 0% real GDP. And so, yes, if we're taking the 2% real GDP we're at right now, plus we add on the 2% additional CPI from the tariff, yes, that's going to create higher inflation, in which case, yes, the Fed should not cut. But if you're adding the 2% from a realm where, say, we're at like negative 1% on the growth outlook because of tariffs, and then you add on that CPI dynamic, maybe that gets us to just under 1% real GDP growth, in which case it probably makes sense to cut within this dynamic. Is that how you're thinking about it, Quinn?
Yeah, I mean, pretty much like, and it's all encompassing. There's a lot of prongs. So I can see why the Fed is hesitant to acknowledge some of these things, but it's just very inconsistent, particularly when you view their actions last year and the 100 basis points of cuts amidst what was by and large a much stronger economic position across the board, and higher inflation than that was in the data. So that's the inconsistency. And I agree, capital flows, that the tariffs thing is not the end all be all, because you adapt and adjust. In fact, coming into this year, it was the third on my list of things I was concerned about for economic growth. Immigration and Doge plus budget reconciliation were 1 and 2, not in that order. So for me, it's a combination of all these things, and those other things are progressing quite rapidly. The budget reconciliation and cuts is coming along. I know there's talks of tax cuts and other things, but Doge is doing stuff, and immigration has basically been halted to zero overnight through the southern border, which I view as growth negative. So, yeah, I think that the market's going to call the Fed's bluff.
Where would you short Z5 for this year? Like for cuts this year, where like would you take the other side of the 2025 December SOFR contract and say, I don't think we're going to price, more than, because right now we're pricing, let's say
3.6.
Yeah, so like we're pricing, 91 basis points of cuts. Like I think if we move back up to 96 or 90, 96, 97 range, I would get I'd probably get short duration if we went back up to there, because every time we've pushed up against there, even with credit spreads a little bit higher, we have that twist, right? And maybe that changes, but we've been having this steepener twist a little bit on the long end. How would you? I would agree with you on that. It seems to me that it's like maybe we have returns for a week in confluence with your view, but I guess I would probably short bonds again, because I think we're still a little bit too aggressive in terms of the speed.
Yes, and in some ways that's a problem for risk assets, particularly the large cap indices, because despite all of the talk of the bond market issues over the last week, which are obviously prevalent, which we were saying on the show, Felix, we're fading China and Japan are dumping, and then we get the data today that they bought more bonds actually.
Exactly.
So
Nice.
it was a balance sheet VAR shock that hedge funds had to unwind, but it is a signpost of the problems that exist in the fact that the last 4 years they've overburdened the market's appetite for U.S. sovereign debt, and there's too much supply. But it's important to remember the broader context, I think, of a yield curve that is still way too historically, not steep. It's very slightly positively sloped. The 10s, 2s is at 50 bips, but historically this is over 100 bips. So what I think was also notable about Powell's speech today and other Fed speak like Waller's was not direct repudiation of using QE necessarily to calm the back end of the curve, but certainly a stated preference to lower the front end, even if they are bumping up against inflation concerns in a slowing growth environment, where they've been talking a lot about this tension that they might find themselves in and might end up cutting rates despite that. And I think the market was, because of the bond market issues on the long end, was getting a little too ahead of itself on like QE restarting and things on that nature, which might end up happening. But I think it's
a political decision.
Yeah. And it's clear to me that I would take their words as willing to cut in use the FFR before anything on the back end. So that's another reason I favor. So right now December shows 3.6 cuts estimated for the year. I don't think that's too far out. What I think is probably too far out is the first cut in June at 80%. Maybe it's not, but then the equity market, I think, doesn't survive at 5,500 then. So it's a kind of two-pronged view for risk.
Yeah, the dynamic is that to unlock the Fed on either side of those potentialities, you need a lot more downside, because you need downside in terms of, first off, you need a bond market where the curve's above 5% at least. And then you also need seizing up within that. And, we talked about this in terms of, like the reason the Fed went in big on the long end in March 2020 is because off the runs went no bid. Off the runs are still well bid. They are, hedge funds on the basis trade are a huge buyer off the runs. So the liquidity is okay. in terms of the short end of the curve, in terms of, the standing repo facility is there. It's ready to go if anybody needs it. So a September 2019 dynamic where, the repo market blows up is highly unlikely, in my opinion. So any sort of financial stability reason for the Fed to step in here is extremely unlikely. So the only outcome is either things get so bad that they need to catch up and cut, in which case they're just going to react to it. They're not going to get in front of it because there's no reason to. So then the last potential, realm here is, do they want to politically step in and just not have the market of having a bond market above 5% and just try to cap it? And that's again, like I was saying, it's a political decision, and they don't want to do that. Why would they want to do that when they have no real reason to, if stability is fine? Tokenization isn't just a buzzword. It's the most efficient way to reimagine how financial assets are owned, traded, and managed. Ondo is bringing traditional assets like stocks and bonds on-chain, unlocking trillions in value and creating open global financial markets. They're not just dreaming big, they're building the platforms, assets, and infrastructure to make it happen. Head to ondo.finance, ONDO.FINANCE, and see how they're bringing capital markets on-chain. Restrictions apply.
You hit it on the head, Felix, because in some respects, the way they think about it, a 10-year going to 5% is helpful in bringing down growth for them. So where the people are freaking out about the instability in the long end of the curve, the Fed in some weird ways might be saying, all right, if I cut 25 bips when the 10 years at 5% or it's at 4.5%, we're in a much more restrictive environment that deserves rate cuts. Granted, if the 10-year goes to 5 and you can guess what stocks are going to do. And then you mentioned in the other side of it is their willingness to step in. Why would they step in when their talk and their upcoming 5-year review is about actually reducing the amount of coupons on their balance sheet, not increasing? So this paired with where I think multiples are on like my updated 2025 earnings projections, I view the equity valuations of the S&P to be about the same as it was, months ago. So I think the risk reward here is just atrocious.
Capital, anything you want to add there?
I would agree on Mag 7. Not really interested in getting long there. I think being long I just think about other trade expressions that I can have in terms of, MP or some other long short pairs connected to any of the, because they're going to get these rare earth metals together somehow, because if they don't, then we have semiconductor issues, and we have compute issues, and it reverberates down the chain. And then just a lot of other stuff with durable goods that I'm, modeling right now for trades. So, I would definitely agree. I think there's better trade expressions and directionality in the top ones, the top Mag 7s. And then the other thing I would say in terms of the government side, I know it's a little late to talk about it, but I still think there's a lot of upside in Palantir. The more and more I dig into and talk to some people about, no one knows what they do. Let's be honest. None of us have a clue. But I do. Looking at where the government contracts are going, I think more and more money keeps going to Palantir, and their market cap is surpassing some of the other government contractors. And I just think maybe the Doge side of things does not, pull. Maybe it doesn't stop government spending, right? Because that's a congressional issue, but it can bring clarity to have it rotate into more competitive companies. So I've been looking into just the entire government spending side and saying, okay, if you have more clarity, but then you have the same amount of money that needs to get thrown at something, where is it going to go? So that's another kind of like interesting, play. And then also I think I shared a chart of, even if you're not going to trade this, there's an interesting chart of the one of the largest metal producers in Australia versus China, and that long short pair. Yeah, that one. So LYC and then divided by the Hong Kong ticker. I just think this is really interesting because if you have this repricing of these risk premiums around the metal side of things and all those rare earth metals, and you begin to slap more things on China, then you're probably going to have a lot of the metal companies that have, you know, comparable things, or they're doing the rare earth mining or production or whatever it might be. There's also some stuff with just the equipment for them. Those are going to begin to be beneficiaries on a relative basis at the very least. And I just think that you're going to have those pressures, like in these long short pairs or these flows, are going to set. I'm trying to connect those with, or have, but like connect those with like, where are we in the US with these, like the transmission of these inflationary pressures from tariffs, right? So like, how are these long short pairs working on this part of the supply chain given these tariffs? How is that connecting into like Mag 7 type names, semiconductor prices, like all these different things? And how is that flowing into CPI, right? Like there's kind of a little bit of a flow to it. And those are the things I'm watching, because these tariff news things are just going to keep creating ranges, I think, in equity rotations and also in bonds. And so in my view, my strategy is taking the other side of these as positioning unwinds, because they're so used to just running these momentum signals as long as, you know, growth is expanding, and they're not really thinking about like what happens if I have to do billions in capex in a week, right? So that's how I think about kind of like views for assets.
Yeah, I like that. I mean, it's probably a bit better for your mental health than trying to predict these tariff headlines. So yeah, give you that for sure. Probably a good move.
The therapy bills just kill you, you know?
Yeah, exactly. How are you guys thinking about Bitcoin these days?
I think the biggest beneficiary to Bitcoin has zero to do, and this is over the past 5 years, has zero to do with the narrative, store of value, all this other stuff that's thrown out there. I think the biggest thing that has shoved capital into Bitcoin has been the surplus of dollars from the US's trade deficit and the Chinese current account surplus. I think that has been the major driver. I think Fed liquidity has played in there here and there, but I think, you know, the fact that Bitcoin has diverged from real rates and reserves and all the other stuff begs the question for a more important driver. And I also think if we look at Bitcoin's correlation with certain currencies during risk on, risk off moves, you have to look at carry trades, things like that. I think there's a lot more explanatory power there than looking at the Fed's bank reserves or the RRP. So I just think in this world, the only way that we have a melt up in crypto is if the US changes its regulation around tokenization and creates the ability for them to tokenize and securitize assets without it being regulated by the SEC, or maybe if there's very loose regulation. And that would create a scenario where any of us could launch a token and have a public market where we can get liquidity in a very comparable way that Michael Saylor is doing right now. But you don't need to go buy a public company that is regulated by the SEC, where the securities are regulated by the SEC. I think that is possible. I think if that happens and it overlaps with some developments in AI where autonomous agents are a little bit easier to program, which I've been working on one for months now, and it's really hard. So I think if they make some developments on that and you have this tokenization shift in terms of regulation for the US, then I'd be more bullish Bitcoin and I'd be more bullish crypto overall. Until then, I just think the entire macro backdrop in terms of contracting global liquidity for dollars, if these trade flows change, is not bullish on a very long, let's say for 2025.
That's interesting. I haven't heard any of that. Those are unique views. That's cool.
I came into last week excited about a potential bottom in risk assets for up to multiple months, maybe multiple weeks. This is from the like April 4th, Friday into April 9th, Wednesday. And Bitcoin was my favorite, Bitcoin and stocks, but Bitcoin I expect to outperform, which it has. But the problem is that we are speed running things so quickly. I mean, the S&P went up 12% in one day. I mean, these are extreme moves. And coming out of this weekend, reevaluating how things have traded and how market events transpired, right? We ended Friday of last week with that Fed comment around we will step in, a non-voting member, but we will step in if need be, and the sentiment was pretty dire. But what I noticed was, the interest rate and financial restrictiveness of spreads, and when you look at any kind of measure of financing conditions, have not really abated. I mean, yields are down this week, but it's sort of like a vol crush type of thing. It's not great. A lot of the flows data is showing exorbitant buying of bonds in the last 2 weeks, and from a flows perspective, from like a kind of longer term money flows, and yields are up from where they were before. And so normally when you have markets going kaput, yields down act as a normal stabilizer for both risk assets, because the cost of capital, it's less attractive to own bonds yielding lower. And so you want to push your capital further out the risk curve, but also in the real economy where turmoil hits. Yes, I might have just lost some wealth effect on my asset base, whether I own stocks or a house, but my financing costs as a business owner, as a person, as a home buyer go down when yields go down. You see a boost in mortgage and other housing related activity, which is a big driver of the US consumption economy, yada, yada, yada. In this case, that natural stabilization effect was not there, and it was a negatively reflexive idea where if you're in a 60-40, last week your 60 and your 40 got smoked on the same days. And in the real economy, that works the same, where your house price fell and your financing costs became more expensive. And that matters in terms of the stabilization effect in the real economy. I don't like how things have traded this week. I also think for Bitcoin, maybe even more important in the near term, is that we didn't actually hit any circuit breakers, panic, policymaker shifts. We got a tweet from Trump that lightened up on his policies, but was no shift really, if we're being honest. I mean, I'm wrong if you believe tariffs are going to come off, I'm wrong. If they don't settle, if they get trade deals that take tariffs off completely, I'm wrong. But in this case where most of the negative headwinds that persisted still persist, and there was no required policymaker intervention from the Fed or Treasury, that's kind of what I was expecting if things kept going last week and when I was getting bullish Bitcoin. But it's almost negative that we didn't have to touch any of those off, and that you have Besson and Powell and everybody coming back out now and saying, we're good. Last week was normal functioning. Some hedge funds were over-levered. That's their problem. Powell saying everything was orderly and as expected. VIX at 60. I would probably disagree, but I'm taking them at their word, which is they're not looking to step in. So my view of Bitcoin is I subscribe to many parts of this liquidity release valve thesis, like a bet on expanding M2 and all these things. And the dollar's weakening, great. It's creating potential energy and room to stimulate down the road. But it's not translating into actual policy effect. And there's no policy pivot. And if anything, there's a policy hardening. So it's a precarious position where I think that Saylor's kind of the only one in the market. And usually those don't last. So I unless there's a policy pivot, it's hard to get excited when we're back to range highs.
Yeah, it just feels like lack of it. Like it's just dead money for a while. Yeah, maybe. Like I still think I'm pretty accommodative to the idea of it getting caught up in and beta correlation to the downside for a bit. I think eventually, once this degrossing happens, whenever it does, it's going to outperform equities quite significantly. It's just about when that'll be. I don't think it's time yet, but I do think it's there. It's just, yeah, it's either dead money. There's a lot of lack of upside at this juncture. Like, I think the 50% retracement on the Qs is something really significant would have to change to get above that. So it's either you're just holding out for this chop bleed for a couple months at least, I think, or you're trying to just wait and cash until this all settles and you get that catalyst. It's sort of one or the other, I feel like.
Felix, question for you on the piece you wrote highlighting I think you articulated what we all hope happens in terms of its decoupling from U.S. stocks and U.S. risk assets and becomes a more globally viewed instrument that benefits from liquidity, even if that liquidity is resuscitating a U.S. market and U.S. stocks and earnings aren't rising that quickly. Do you believe that the proximity and adoption from Trump and the U.S. as a whole to the, even as far as a potential strategic reserve and all these adoption metrics, do you think that goes against, is kind of like a headwind for that thesis that we could decouple? If it has, in many ways, crypto and Bitcoin has become a U.S. asset, a U.S. asset. Germany dumped theirs last summer. China banned theirs in 21. There's not a lot of big sovereigns at the table anymore around it. And so I just wonder where you stand on that being a risk to that thesis playing out.
Yeah. So if we were at a point right now where China was a big proponent of it and they had a lot on their book, I'd probably be a lot more concerned in terms of just the activist nature of them being able to now ban it and then sell it. And if they view it as a US based asset, but they don't. So that tail risk is off. So then it's, what about the rest of the world? Yeah, that I feel like that's dependent on understanding where we go here in terms of tariff negotiations. Like if it continues to deteriorate significantly, that's a valid concern. But probably in the same level of concern of what I'm concerned about, which is capital rotation out of U.S. denominated assets. I would just bucket it in the same level. It's like U.S. treasuries, U.S. equities, and then Bitcoin, and it's just like get out of all of them. So yeah, maybe there's a certain lack of upside because of that that's underappreciated, but I would be a lot more concerned about it if China was previously a much larger player in that base, I think.
Yeah, that's fair. Yeah, it's in that respect, it's like a good thing that they got washed out in 21 then.
Yeah. All right, guys, that was a good one. Any other final thoughts, Capelos, to wrap it up before we let you go here?
No, it was cool. I love hearing the views and bouncing ideas back and forth. It's always thought provoking and always a good time.
Yeah, man, always good to get you on. Love it.
Appreciate it.
Happy Easter.
Cool. Yeah,
and
happy
Friday.
Easter. Have a good long weekend, everybody, and enjoy it.
Enjoy, guys.